Welcome back to our last element on text transparency. Now we're talking about effects. And before we dive into the literature on effects of text disclosures for corporations, I would like to motivate this whole discussion with a prime example, I think, of how text transparency widely defined can matter. And for that, I show you here a little animation that was part of a New York Times article by David Leonhardt on the distribution of total taxes across individual wealth groups in the US. So this analysis goes back to work of Zass and Zuckman on taxes in the US. So they have written this very influential monograph on the fairness of the US tax system. And a lot of this debate around this injustice or perceived injustice of the taxation system in the US was very influential for the US election and also for the current debate on the minimum corporate tax rate initiative worldwide. So this is really as big as it gets when it comes to impact. Okay, so now why I like this graph a lot is because it communicates a very simple but important finding. It communicates that starting from the 50s, so here the tax rate that the highest income earners in the US pay has decreased dramatically from 70% down to, so when you do the animation here, down to just shy of 25%. So now this is the most recent data point that is in this analysis. This is just after the Trump Tax Act. And you see that here, matter of factly, these top 400 income earners in the US actually had the lowest tax rate. Yeah. So of all income groups. Wow. Yeah. So take this tax progression. So now, one remark here. I hope it's obvious to the economists here, but we are talking about tax rates, right? We are not talking about tax money. So obviously, the top 400 income earners still pay much more than the lowest income bracket, simply because they have higher income, right? But the tax rate is what is so low. Now, when you see this animation here, I think you instantly get the idea to ask these very simple and straightforward but important questions. So how does this actually come? Yeah. So why does this change so much? Why is this effect so drastic? And this way, by asking these questions, actually this information can change, beliefs and attitudes, and even political leanings. So this is why tax transparency matters. Yeah? So we want our political citizens to be aware of trends like this. And for this, we need tax disclosure. So here, the data underlying all this also incorporates corporate taxes, but in principle, of course, it's very much focused on the individual. But you could ask similar questions related to corporations. So how do corporations fare in terms of the taxes that they pay, conditional on where they are located? How do national corporations compare to multinational corporations? How do they compare across the globe? All these type of questions are questions that can be answered with good tax disclosure data. So I believe that in principle, tax transparency matters and can make a difference. But now the question that we have to ask in the accounting literature is whether the specific tax disclosure matters. And this is a very different story. Why? Because this is a relatively young field. And so the literature is still emerging on the topic, and it's not yet conclusive. At least this is the takeaway from Müller, Spengel, and Weil that have spent much more time with the literature than I did. So I completely trust them on that one. I also think that it really matches well with my own understanding. So It's an exciting area, much work being done, but it's also relatively hard to assess the impact of disclosure, as we know from the financial accounting literature. So we shouldn't be surprised that there's no entirely clear picture as of now. But let me give you some pointers in papers that I find interesting. And again, of course, these papers are listed in the literature section at the end of the slide deck, so that you can all Google them up and give them a read. Okay, so the first thing, you have to separate the different disclosure types. And when it comes to private disclosure, there are some relatively new and interesting papers that more or less seem to indicate that these private disclosures of country-by-country reporting to the OECD countries has had an effect on the way that corporations plan their taxes, and also related to that, how they chose their locations, right? So this is a nice paper by Yoshi and JAR 2020. And there is a working paper that is, I think, also relatively close to being published by De Simone and Albert, that looks into a similar setting, right? So these two studies, they both show a certain effect of these private disclosures on the behavior of firms. So this seems to work, although it's really hard to understand what firms really do, because the data that we can observe is of course very limited, because it's limited to the public disclosure. So still, it would be interesting to understand more how this mechanism actually works out, whether it is the tax authorities actually coming back to the firms and questioning about their behavior, or whether it's the firms proactively changing their behavior. So the latter seems to be also consistent with a finding by O'Donovan et al., published in the Review of Financial Studies on the Panama Papers. So the Panama Papers were one of these big leaks where private information on corporate tax behavior was made public. And so the general reading of this is that this also led to the disclosure of behavior that is borderline tax evasion, so that you get this feeling that maybe, the corporations that were part of the Panama Papers, they were a little bit insecure whether they were caught in the act, or whether this is just an annoying disclosure of something which is completely legal. But what the O'Donovan et al. Study finds is a change in behavior, and change in firm behavior, also in terms of investment and activities, that is consistent with a higher level of scrutiny by tax authorities. Again, this is hard to observe, but it seems so. If you want to understand why they changed their behavior, it's the best explanation, at least also for me, is that they changed their behavior because they are concerned of tax authorities going after them. And of course, they would be concerned about this if they are insecure whether their behavior is borderline tax evasion, meaning borderline illegal, right? So this is something, if you take these two bullet points together, you have this feeling that in total, the communication flow between firms and tax authorities seems to be linked with actual behavioral changes of firms. Yeah. So, in other words, this private disclosure thing seems to work at least somehow, although we don't really understand well how it works. At least this is my take on it. So now when we come to the public country-by-country reporting and other tax disclosures, then this is a very rich literature when it comes to the general tax footnotes, and I'm not going into that literature right now. But what I want to talk a little bit about is the new and emerging literature on public country-by-country reporting. There are also more papers than obviously the paper in CAR by Yoshi and co-authors. But I think it's interesting because what this paper shows us is something that sounds a little bit frustrating, but in the end could be also interesting for further studies, because they find that, well, it seems to be that after the European regulation of public country-by-country reporting was imposed, that there's less income shifting, but it doesn't really mean that they pay higher taxes. So it seems as if they changed one tax planning strategy for another. And of course, this is something that if it really happens, then this wouldn't be that exciting for the regulator, right? Because the overall objective is this public country-by-country reporting would trigger firms to pay their fair share of taxes, whatever that is. And if there is no real change in that regard, then it would be a little bit of a letdown, right? So now we come to something that I find puzzling, but also very exciting. So the first thing is, and it's similar in the financial disclosure literature, but I'm always surprised to see how fast the literature jumps to real effect outcomes, for example, location choices, investments, and so on, without providing, let's say, smoking gun evidence that the public actually uses the information that has been disclosed, right? So there is very limited evidence on this. So there are analysts, financial analysts who use the public tax disclosures, that investors really use it. So it's really a little bit like, yeah, the disclosure is there, and then some miracle appears. Somehow this has been impounded into the decision making of managers, and this is why they change their behavior. Yeah? So we don't really know whether it's the investors driving it, whether it's the analysts driving it, whether it's the managers driving it themselves. We don't know. Yeah, and in that regard, and this is the last thing that I want to talk about here, is there is also a very interesting paper by Assay and co-authors, which is still working paper on SSRN about tax boycotts, right? And here, I think this is really something that I like a lot in terms of the topic. So here they ask the question whether this is actually a thing. So whether consumers actually boycott firms because of their tax behavior. And in a nutshell, with a very rigorous analysis among multiple angles, they don't find any evidence for this being the case, right? So what they find is that when they survey customers, that they say that they boycott firms. Yeah, around a third of their respondents say that they boycott firms from time to time, but they don't boycott them because of taxes. They boycott them for other reasons, right? So this is the first thing, which is, I think, relatively interesting. And then they also look at consumer purchase data, and so looking at consumer purchase data, they also find no evidence that actually consumers react to discussions about tax aggressiveness of corporations or something like this. And even when they look at rather extreme cases, like for example the Starbucks case in the UK, that was highly publicized, still there's relatively little evidence that something on the consumer end actually happened. So this is interesting among two dimensions. The first dimension is there's always this argument that maybe investors should be interested in firms not having a too aggressive tax strategy. Not that much because this is the right thing to do, but simply because if they would be too aggressive, that would lead to problems with the market side, meaning that they might lose sales because consumers are unhappy. So this is not being supported by the Assay et al. Analysis. So meaning that in the end, it could still be a rational strategy for firms to be relatively tax aggressive if consumers don't care about it, right? But then on the other hand, there are these survey results by Graham et al. Where managers say that they are really concerned about reputational losses from potential tax aggressiveness being disclosed. So it seems as if managers are very concerned about this, but consumers don't care that much. Isn't that interesting? And to me, obviously this is just speculation now, but to me this sounds a little bit as if managers are more concerned about their own reputation than the actual reputation of the firm. Yeah, so maybe the reputation of the firm as a brand or as a product or whatever is more robust when compared to the individual reputation of a manager who engages in tax aggressiveness. So that means that maybe managers will shy away from tax aggressiveness, not so much because they want to protect the reputation of the firm, but maybe because they want to protect their own reputation. Okay, so as you see here now, these are some papers that I picked. I can only recommend you to take a look at the Müller et al. Review because they have a very thorough read of the literature, I think. And there's a lot of interesting stuff in there for you guys to explore. But the overall takeaway should be we don't know much yet about this. So this is really an area where I think further study is needed. And one thing that I would particularly be interested in is to understand, well, how can corporate tax disclosures be made more impactful in terms of communication? So going back to the New York Times income tax display that I showed you at the beginning of this video. So what is the way that tax disclosures can be made informative for the average user? Yeah, so keep in mind, taxes are complex. Multinational corporation taxation is even more complex. If you want to communicate, if you want to increase tax transparency, it's about information as being received and processed by the receiver. Only if the receiver can process the information, it actually can change the transparency. So this is why I think there's work to do. Okay, perfect. See you in a bit in the discussion session. Looking forward to it. Cheers and bye.